Hi everyone, Gustavo here, helping you understand insurance, retirement, and financial protection in a simple, clear way. Today we're breaking down something that confuses a lot of people: the fees inside Index Universal Life (IUL) and Variable Universal Life (VUL) policies. If you've ever looked at a statement and wondered, why is there a yearly charge and a closing account charge? This video is going to make everything crystal clear. Let's jump in. Why these policies have fees? IUL and VUL policies are powerful tools. They give you life insurance protection, tax-advantaged growth, flexible premiums, access to cash value. But because they do so much, they have multiple layers of fees. Think of it like owning a home. You have yearly maintenance costs, and if you sell early, you might have closing costs. Same idea here. The yearly fees, ongoing costs. These are the fees that keep your policy active. They happen every year, automatically. 1. Cost of insurance, COI. This is the biggest one. It pays for the actual life insurance coverage. It increases as you get older because risk increases. 2. Administrative fees. These are small charges for record keeping, billing, and policy management, usually monthly or yearly. 3. Rider fees if you added benefits like long-term care, waiver of premium, protection. Those come with small ongoing costs. Waiver of premium, index or investment fees. 4. IUL, caps, spreads, and participation rates act like indirect fees. 4. VUL, you have fund expense ratios similar to mutual funds. These yearly fees are normal. They're part of how the policy works. The closing account fees, exit costs. Now let's talk about the fees that only show up when you cancel the policy, withdraw too much, surrender early, let the policy lapse. These are not yearly fees. They only happen when the policy ends or is disrupted. 1. Surrender charges. Most policies have a surrender period, usually 10 to 15 years. If you cancel during that time, the company charges a fee. This helps them recover the cost of issuing the policy. 2. Loan payoff or interest. If you borrowed from your policy, any outstanding loan must be settled. 3. Fund liquidation fees, VUL only. Because VUL uses investment subaccounts, selling them can trigger small fees. 4. Market value adjustments. Some policies adjust values if you withdraw too much too soon. These are the closing account amounts you see on statements. Here's the easiest way to understand it. Your yearly fees keep the policy running, like maintenance. Your closing fees only apply if you cancel early or withdraw too much, like a contract termination fee. That's it. 2 categories. 2 purposes. No mystery. If you found this helpful, hit the like button and subscribe. I post clear, simple videos every week to help you understand insurance, retirement, and financial planning without the confusion. Rider fees if you added benefits like long-term care or even supplement. This would add additional costs. Thanks for watching. See you in the next video.